Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be taking a look at Lululemon stock. I've had a lot of requests for this one recently because the stock price is down about 30%, I think. More than 30% off its highs. Obviously a great business, so we're going to take a look at it. As always, this is not individual investing advice. This is just how I analyze stocks. If you have a stock you'd like me to take a look at, just drop it down in the comment section. If it's one that's in the S&P 500, I usually post those here on YouTube for free. If it's not in the S&P 500, I post the rest over on Patreon. There's a free tier level there now, and at the $5 tier a month level, that's where you can just ask me any stock or whatever, and I'll tell you what I think about it and do a little analysis. As long as it's one of the kind of three main analysis that I use on the channel, then you can just request it over there. And if you ever decide to join the full Cyclical Investors Club service, where I have all my strategies, the spreadsheets, everything that you kind of see me using here, you can get a big discount if you are signed up over at Patreon. And that is hosted over on Seeking Alpha. I'll have the links down in the description. I'm also going to be using fast graphs in this video to show some of the data. I have a 25% off affiliate link for fast graphs down in the description too. If that's something you're interested in trying out. So with that, let's take a look at Lulu. So Lulu is well known, obviously. They IPO'd during the Great Recession, it looks like. And these guys are, like apparel industry. They are pretty big. So the first thing I look at is like they're a $44 billion company. And apparel can be really tricky industry to invest in. If you get a good one like Lulu really early on, I mean, that's kind of the best way to do it. When they get bigger, then it becomes they're more kind of trying to defend what they've already built up. And consumers can be a little finicky over time in terms of what they like to buy and what brands they like. So I'm always a little bit cautious, I guess, when it comes to like apparel companies generally. So that's just something to keep in mind, and kind of my first initial thoughts. But obviously, Lulu has been a fantastic business. If you just bought the stock way back there, you'd be up a couple %, 20% CAGR. So that's really good. However, if you paid a 60 PE or something, which is what it was trading at back here, even though earnings have grown dramatically over the past few years, the stock has only returned about the same as inflation. So what you pay for a good business or even a great business is important too. You don't want to pay too much because they've more than doubled actually. This is what, $4 and we're up to 12. So they've tripled their earnings, but if you paid a 60 PE, you're not up 200 or 300%, right? You're basically just a little above even. So the valuation is worth keeping in mind. So also, because there's not any like really long-term data, it's good enough that you can go back and look at it, but it's not like a Nike or something like that, where we could go back to the Great Recession, we could go back to the early 2000s, see what earnings did during that time, kind of see how cyclical they might be. I don't think Lulu's apparel is particularly cheap, so it's possible that if we had a recession, people would pull back on those purchases, and it could be cyclical. I would expect it to be at least moderately cyclical during recession. So that's but we don't have any like hard data really to know. But it's worth being cautious. So if you look at let's go back to, usually I just start at 2015. They had a couple slow years here. Maybe we'll just do 2016. And we'll go to the end of 2025. Okay, actually this is 2015 because they starts in January instead of December. If we look at fast graphs earnings growth, we're looking at 22% earnings growth during this time period, which is really great. And usually that's what I do. I look at what they've done historically. And I typically would, my base case, I kind of extrapolate that out. But because these guys are a lot smaller business, growing into a much bigger business, it makes it a lot harder to grow at that kind of a rate. So I wouldn't assume that they can keep growing at 20% in this case. I also, because there's not really good recession data, that's another reason to be more conservative. And so what I'm doing is I'm assuming when I look forward, analysts think earnings can grow at 12% a year. Basically, that's what I'm going to use this time. So that's a lot more conservative than the 20% earnings growth they've actually been able to do. But that 20% earnings growth didn't include like a real recession. So it probably would be lower if we had a real recession. And that was when the business was significantly smaller than it is now. So it was easier for them to grow at that faster rate over the past decade. It's going to be much harder to grow at that kind of rate over the next decade. So even though I lean heavily on history, there's always, usually it's like an 80%, 20% thing. Like you can go, history you can give you like 80% of the information that you want if the history's there. And then the other 20%, you have to use your brain in each case and just kind of, think about kind of the context in which everything is taking place, which is what I've tried to kind of lay out here. So the PE is 26. That's not crazy expensive, like the 60 or whatever, like this, or even they were up almost to 70 during the peak here. But it's not like super cheap, right? So we'll run a valuation analysis and see how they look here. So I assume the earnings grows at 12%. They didn't really have any significant debt to worry about, so we don't have to make any adjustments there. Let's see. I don't have their PE listed here, but I do have the earnings yield. So 4% earnings yield is about a 25 PE. So that's what I'm going to use, and that's going to be using forward earnings for this year. So if we bought Lulu for $100 and we just owned the business, it would probably pay us back about $4 in earnings a year with the assumptions that we have now. And then I assume that $4 will grow at 12% every year. And if you own this, you could just collect that money over time. So I want to see how much money an owner could collect over time in earnings on their $100 investment. And I go out to 10 years. So over 10 years, for every $100, you should be able to earn with these assumptions about $79. So you have $100 and it grows into $179. If you put that in a CAGR calculator, it should come out to about 6%. So that would be the expected 10-year CAGR buying at this price and assuming earnings are going to grow 12%. That's less expensive than the average S&P 500 stock right now, but it's a little bit over, like 6.5% is kind of what I would consider like the midpoint of fair value. So I would say it's probably kind of fairly valued here. Not super cheap, but on a relative basis, it probably is cheaper now that the stock has fallen like 30% than a lot of the other S&P 500 stocks. Now, in order to become a buy, I would typically, the level I'm aiming for here is 8%. So when the stock price goes down, the returns go up because you pay less money for more earnings, or you pay the same amount of money for more earnings. So when I do the math on this, or I check it out, the price of $241 a share right now, it's $354 is where it trades right now. I'm looking at a buy price of $241, which is about 32% lower than where it trades right now. This would have a margin of safety involved as well. So maybe they grow slower, maybe there is a recession, and maybe it's worse than expected. All those things are what the margin of safety is trying to take into account. And that's where the initial level I'd be aiming to buy. I would say, because we don't have recession data though, I think for this one, rather than trying to buy it on the way down, I would want it to get below this level here and then have the stock price start coming back. And I measure that with a momentum score from Seeking Alpha. Right now it has a D+. I would want that to be a B- or better. But you could use like some other kind of technical analysis, like a 200-day simple moving average. After it dips below 241, If it rose above that, then that could be a good time to potentially buy, because you're getting a decent value and a higher potential of a bottom. I mean, you never really know what's going to happen, but it could kind of help you get a better price potentially, or at least prevent a person from having to sit through a deeper potential downturn if there's a recession or something. So that's kind of, because we don't have good recession data, because it's a pretty big company now, because it's kind of a discretionary purchase, all those things, that's kind of what lead me to being a little bit more cautious in this regard. So yeah, in a perfect world, it would, if earnings were similar, maybe they dip a little bit or whatever, the stock falls to 210 or something, and then when it starts to come back, while it's still below that 241, and the tide looks like it's turned, like that would kind of be the ideal time, I think, to come and buy it. For one, the business would be valued less, so it would be more like a $30 billion company. That potentially gives them more room to grow. It gives you more margin of safety. Now, is that going to happen? Who knows? I follow like 600 stocks that interest me, that have metrics that make them at least worth following. Lulu is one of those. And so I try to watch a lot of them. So if one falls below my buy price and meets my metrics, then I come in and buy it. But whenever that happens, there's going to be 600 others that don't that month, So it really just depends on the investor and the individual strategies that they're using. It also depends on, I take small positions too. So I monitor a lot of stocks, and I do this every day. So it's kind of my job. And I also usually take my position all at once. If a person wanted to kind of layer into it, then that's fine. You start building a position at whatever, fair value maybe, which we'll say is like $300, and then you layer down to 200 or something. You could have a strategy like that. But and then if it doesn't get all the way down, well, at least you have a little position that can hopefully do well. So that's totally a perfectly decent way to do it. It's hard for me to do it that way because I try to track my results for members and everything, so we can see how things are doing. And if I have if I have 100 positions that I've layered in 10 times each, then that's just too much for me to keep track of. But at an individual investor level, it's perfectly fine to do that. So those are the metrics I'm looking for. Yeah, I'd say it's probably pretty close to fairly valued here if the price fell just a little bit more. And then hopefully they can keep those earnings coming in as expected. And well, hopefully for people that don't own it, we get a little surprise, something negative that comes along, then get the market to kind of overreact. We already have this kind of stock price decline. So if we could punch through some technical level and it dips really far, I mean, that would be good for people that want to buy the stock at a better price. But we'll just have to wait and see what happens. But those are my thoughts on Lulu. If you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comment section. I'll get it on the board behind me, the whiteboard. Still quite a few up there I need to get to, although a lot of them are marked off. I'm working my way through it pretty fast. And I'll see everybody later. Bye.